Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of step-by-step guide to the Black-Scholes model for beginners. Black-Scholes model explained how it revolutionized options pricing and risk management. The Black-Scholes model changed the way investors think about options pricing. Before its introduction, predicting an option's fair value was inconsistent and complex. With this model, traders gained a mathematical framework to assess risk and set prices more accurately. Its influence stretches beyond pricing, shaping modern finance as we know it. Understanding the Black-Scholes model. The Black-Scholes model stands as one of the most important innovations in modern finance. It provides a standardized way to calculate the price of financial options, which are contracts that give the right, but not the obligation, to buy or sell an asset at a set price. Before this model, determining a fair price for options was more guesswork than science. Let's break this down. Definition and overview. The Black-Scholes model is a mathematical formula used for pricing European-style options. These are options that can only be exercised on their expiration date, as opposed to American options, which can be exercised anytime up until expiration. The formula estimates the fair value of an option by factoring in key variables like the current price of the underlying asset, e.g., a stock or commodity, the strike price, the predetermined price at which the option can be exercised, time to expiration, how long until the option expires, volatility, how much the price of the underlying asset is expected to fluctuate, risk-free interest rate, a theoretical rate representing returns on a safe investment. By combining these inputs, the model predicts what an option should be worth today. Its primary purpose is to eliminate guesswork, providing consistency and precision in the pricing process. Beyond options trading, the Black-Scholes formula is widely used by hedge funds, banks, and other financial institutions to evaluate risk. Think of it as a recipe where each ingredient, price, time, volatility, and so on, comes together to bake a predictable result. This consistency is what makes the model indispensable to financial markets. Historical background. The Black-Scholes model was introduced in 1973 by economists Fisher Black and Myron Scholes. Later, Robert Merton extended the model's reach, providing further mathematical refinements. This groundbreaking work earned Merton and Scholes the Nobel Prize in Economic Sciences in 1997. Fisher Black was deceased at the time and therefore ineligible for the award. Why was it such a big deal? Before their research, there wasn't a universal method for pricing options. Investors relied on intuition or rudimentary models that often fell short, especially in volatile markets. The Black-Scholes formula filled this gap, offering a clear and logical method rooted in mathematics. Their work didn't just stay on paper, it revolutionized trading floors. It gave traders a common language and framework for options pricing. The model's influence also extended to risk management, helping institutions measure and manage uncertainty more effectively. In short, Black, Scholes, and Merton didn't just solve an academic problem, they shifted how global finance operates. Their collaboration stands out as a prime example of theory meeting practical, real-world needs. Key components of the Black-Scholes model. The Black-Scholes model relies on several key inputs to calculate the price of an option. Each component plays a distinct role in determining the fair value, and understanding these variables is crucial for anyone looking to use the model effectively. Let's break down these building blocks and what they mean in practice. Stock price, S. The stock price represents the current market value of the underlying asset, and it's the starting point for the entire calculation. Why is it so important? Think of it as the foundation for any option contract. Everything builds from this value. If the stock price rises above the strike price for a call option, the option holder stands to gain since they can buy the stock at a lower than market rate. On the flip side, a drop in stock price below the strike level impacts the intrinsic value of a put option. Small changes in the stock price can significantly affect the value of the option, making it one of the model's most sensitive inputs. Strike price, K. The strike price is the agreed-upon price at which the underlying asset can be bought, call option, or sold, put option, when exercised. This input acts as the benchmark against the current stock price and directly influences whether the option has intrinsic value. For call options, if the stock price is above the strike, the option is in the money. For put options, the option is in the money when the stock price is below the strike. For example, if the strike price is $50 and the stock is trading at $55, a call option would have $5 in intrinsic value. This difference between stock price and strike price is a cornerstone of option valuation. Time to expiration, T. Time to expiration refers to the days, or fraction of a year, left until the option contract expires. Options are time-sensitive assets, meaning their value diminishes as expiration approaches. This phenomenon is called time decay. Here's how it works. Options with a longer time to expiration are generally worth more. Why? There's more time for the underlying stock price to move in a way that benefits the option holder. As expiration nears, time value erodes, especially for out-of-the-money options. Think of it like a countdown clock. The closer you get to zero, the less flexibility and potential upside the contract offers, leading to a sharp decline in value. Risk-free rate, R. The risk-free interest rate represents the theoretical return an investor would earn on a completely safe investment, like a U.S. Treasury bond. Why does this matter for options? The Black-Scholes model assumes that investors can lend or borrow money at this rate, making it a critical piece of the formula. Here's where it fits in. For call options, a higher risk-free rate tends to increase their value. This is due to the cost of carrying the position being reduced. For put options, the opposite happens, a higher risk-free rate can decrease their value. Although small in comparison to other inputs, changes in the risk-free rate can still have an impact, especially in a low-interest environment or during times of economic uncertainty. Volatility, sigma. Volatility measures the degree to which the price of the underlying asset fluctuates over time. It's often considered the most important factor in option pricing since it reflects the market's uncertainty about future price movements. Unlike other inputs, volatility isn't directly observable and must be estimated. Traders use historical volatility, how much the stock has moved in the past, or implied volatility, derived from current option prices, to plug into the model. Here's how volatility affects an option's value. High volatility means larger potential price swings, increasing the likelihood of the option becoming profitable. Both calls and puts become more valuable in this scenario. Low volatility signals smaller price moves, reducing the option's potential upside and, therefore, its price. Think of volatility as the speed limit on the stock's price movement. The faster it's expected to move, the higher the chances it hits a profitable target, making the option more expensive. These components work together like gears in a clock, each pushing the calculation toward an accurate fair value. Removing or miscalculating any one input can throw off the entire result. When used correctly, they make the Black-Scholes model one of the most powerful tools in modern finance. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.